Hi, welcome back to Solution in YouTube channel. In today's video we will learn about the return on equity. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to a company's assets minus its debt, return on equity is considered the return on net assets. Return on equity is expressed as a percentage and can be calculated for any company if net income and equity are both positive numbers. Net income is calculated before dividends paid to common shareholders and after dividends to preferred shareholders and interest to lenders. Return on equity is considered a gauge of a corporation's profitability and how efficient it is in generating profits. Average shareholders' equity is calculated by adding equity at the beginning of the period and at the end of period divided by 2. The beginning and end of the period should coincide with the period during which the net income is earned. It is considered best practice to calculate return on equity based on average equity over a period because of the mismatch between the income statement and the balance sheet. So how much a return on equity should be? Whether a return on equity is deemed good or bad will depend on what is normal among its stock peers. For example, utilities have many assets and debt on the balance sheet compared to a relatively small amount of net income. A normal return on equity in the utility sector can be 10% or less. A technology or retail firm with smaller balance sheet accounts relative to net income may have normal return on equity levels of 18% or more. A good rule of thumb is to target a return on equity that is equal to or just above the average for the company's sector or those in the same business. For example, assume a company, Master Tech, has maintained a steady return on equity of 18% over the past few years compared to the average of its peers, which was 15%. An investor could conclude that Master Tech's management is above average at using the company's assets to create profits. Relatively high or low return on equity ratios will vary significantly from one industry group or sector to another. Still, a common shortcut for investors is to consider a return on equity near the long-term average of the S&P 500, that is 14%, as an acceptable ratio. And anything less than 10% is poor. Let's take an example. Assume that in a particular year, PEPSI has total assets of $5 million and total liabilities of $2 million. This will give us equity of $3 million. Similarly, total assets of Coca-Cola is $10 million and its current liabilities are $3 million. This will give us equity of $7 million. These were the balance sheet figures. Now let's assume the income statement figures. PEPSI has net profit of $350,000. On the other hand, Coca-Cola has net profit of $920,000. Now let's calculate the return on equity for both companies one by one. Using the formula for return on equity, the ratio for PEPSI is 11.67% and for Coca-Cola, it is 13.14%. Coca-Cola has generated better returns than PEPSI. Return on equity can be used for other calculations of finance as well. Sustainable growth rates and dividend growth rates can be estimated using return on equity, assuming that the ratio is roughly in line or just above its peer group average. Assume that there are two companies with identical return on EQYQYs and net income with different retention ratios. This means they will each have a different sustainable growth rate. The sustainable growth rate is the rate a company can grow without having to borrow money to finance that growth. The formula for calculating SGR is return on equity times the retention ratio, or return on equity times 1 minus the payout ratio. For example, Company A has a return on equity of 15% and has a retention ratio of 70%. Business B also has a return on equity of 15% but has a 90% retention ratio. For Company A, the sustainable growth rate is 10.5% calculated by 15% multiplied by 70%. Business B's sustainable growth rate is 13.5% calculated by 15% multiplied by 90%. If you have understood the concept, give this video a like and subscribe for more lectures. If you don't understand anything related to this video, please ask us in comments. See you in our next lecture. Take care.